How can transfer pricing save you a lot of money on your taxes, but it could also give you the biggest headache? First off, what is transfer pricing? So transfer pricing is a concept where you own two or more business entities in different countries, and essentially they're doing business with each other. I think the biggest thing is that both entities are majority owned by, the client, in this case, Mr. X. And so if Mr. X owns two entities, majority owned by the same person, they are called related parties. And by doing business together, these related parties have to have something called arm's length transactions, right? And so again, just overall, even explaining this sounds like a super pain. And it really is for tax compliance and figuring out the relationship between the two, but it can also be a great tool for tax optimization. So again, what is transfer pricing? Transfer pricing, essentially the rules and methods for pricing cross-border transactions between businesses with a common ownership or control. So let's go to an example because, of course, not all tax jurisdictions are equal. And so there are different tax rates for each jurisdiction. And hence, transfer pricing essentially ensures that even if there is, quote unquote, profit shifting to a lower tax jurisdiction, that it's done within reason and within what the market would allow, right? So again, any sort of applying proper transfer pricing is a must for tax compliance as well as strategic optimization. And so here you can see basically transfer pricing can be for products, right? If you're buying a product from a manufacturer, reselling it to retail in different countries. It could be a service where, let's say, one entity that you own is offering services to another entity, like a staffing agency. It could be an IP where there's IP in one country and it's being rented or be paying royalties from another country, and any other type of intangibles. And so let's look at this example. So you are an Amazon seller and you're selling worldwide and you are buying goods from China via your Hong Kong company and you're selling throughout the world. In this case, let's say you're selling to a US company and that US company which you own is selling to customers. So in this case, you have a company that has effectively connected income because it is selling to customers in the United States. But you have to figure out what is the price in which you, let's say, buy from China at $1 and then ultimately you sell on Amazon for $10. Well, what price is your Hong Kong company that's buying from China for $1 selling to your US company? Are you selling at $9, which means that there's only going to be $1 profit in the US company and $8 profit in the Hong Kong company, which, by the way, is 0% tax. If there is no effectively connected income in Hong Kong, meaning there is no employees or offices that are done or work that's being done in Hong Kong. So in this case, you have to figure out that relationship, whether it's the goods are being sold at $2 or $9 or likely somewhere in between, so that you can have what would be the market rate between the Hong Kong company and the US company. And that's essentially what transfer pricing is. So again, in this example, you have business two that's essentially buying from the Chinese manufacturer and then selling to business one, which is the US Corp. And so the point is that there has to be a transfer pricing study. Now, what actually is a transfer pricing study? A transfer pricing study is where you actually are studying the market. You are studying to see what is the appropriate price to sell from Hong Kong to the US. So you're actually going and looking and seeing to see the cost of goods for a similar product that is being sold from the manufacturer to the retailer, or in this case, from the distributor to the retailer. And so it's really coming up with a data point of supportable evidence that shows that in the market, if there were two third parties that were unrelated, what would be the transaction cost, or in this case, what would be the price between the two parties? Again, if it's IP, what would be the royalty rate in which the company that has the IP would be selling to a company that doesn't have the IP? If it's staffing, again, what is the typical margin for consulting? If I have said consultants, at what rate would I be leasing them out or charging a third party for consulting services? It's the same thing with transfer pricing, where you have, let's say, staff that is being rented out for said jobs. Now, another big aspect of transfer pricing is tax treaties. Again, reducing tax treaties do a few things in transfer pricing. One is reducing withholding tax on royalties. So again, we're talking about IP, we're talking about using a name brand, marketing, etc. And then another big part of the tax treaty is establishing a MAP, which is a mutual agreement procedure, which outlines the process in which, if there's a dispute between two countries who say, hey, the profit should be shifted over here, over there, there is an actual process to mediate said dispute between two countries where profits should be taxed. And again, as I mentioned, transfer pricing, it's not just a brief legal opinion or quick comparison. It is very specific methodologies, valuation that is being done, as well as carefully documented in a report that you have in case there's an audit, in case it's further examined by the IRS, so that you're able to support. Along with not a transfer pricing study, there is also a transfer pricing agreement. So not only do you have the study that shows the support, but you also have the agreement between the two entities in which you outline, obviously the payment terms, the cost, or maybe it's a cost plus model. Maybe, for example, I'm having said employee at paying him $100, it's a cost plus 10%. So I'm billing said employee at 110. So I'm being, paid 110 from said company, and then I'm paying the employee $100. So as you can see, it's a super pain from a tax compliant perspective. But when you have the option to potentially put some of the profits in a low tax or no tax jurisdiction, and it's for genuine business purposes, in this case, maybe you're actually buying from China, and obviously, as we know, Hong Kong is the primary place to do business in China internationally, then it makes sense. So from a tax optimization standpoint, it could be something such as IP, or even just the relocation of certain activities to lower tax jurisdictions. So for example, you see a lot of tech companies that have big offices in Ireland. Why is that? Because Ireland has one of the lowest corporate tax rates in all of Europe at 12.5%. So rather than set up the European headquarters in a place like the Scandinavian countries or the Nordic countries, or Spain or France, where corporate tax is much higher, a lot of these tech companies, LinkedIn, Google, have offices in Ireland. Same thing with their Asia headquarters that are generally based in Singapore. Again, why? Because they're shifting profits to these lower tax jurisdictions. And then again, you see it from obviously the big multinational companies all the way down to clients that we help to, again, validate the reason for setting up or doing business or being incorporated in lower tax jurisdictions. Of course, what are the risks for not doing transfer pricing right? You get significant tax exposure. You can get hit for double taxation. Of course, non-compliance and scrutiny from any type of authorities, whether it's the IRS or other authorities. And so I think the biggest thing when it comes to transfer pricing is documentation. And I really stress everybody, if you do have multiple companies in multiple jurisdictions, get a transfer pricing study, get a transfer pricing agreement between all of them, button up everything, because the biggest documentation is your biggest friend. If you have any questions at all about transfer pricing study or any type of cross-border transactions around the world, reach out to us, get a consultation with Global Expat Advisors. We're happy to help.